Americans down on the economy, down on stocks, and worried about their retirement. Take a look at the outlook here. If there's a good time or bad time to invest, I'll cut to the chase here and say this is one of the largest gaps between those who are negative, saying it's a bad time to invest in stocks, versus those who are positive.
We've had a government, I'm talking about the U.S. now, that in 2000 we had an $8 trillion deficit. And today we have a $33 trillion deficit. So the deficit's grown by more than $1 trillion each year over the last 23 years.
Everyone seems to be getting pretty relaxed and confident because the alarms have been resounding for a while, and still, nothing has happened. Yet, all indicators point to the fact that the stock market is gradually spiraling towards a devastating crash. To many, we probably sound crazy at this point, or perhaps a bit paranoid, but listen. History has proven that it's those who stay perched on the edge of their seats, monitoring the times and seasons, who actually see the storm coming and are able to take cover in time. So call it paranoia or whatever, but I can assure you that a stock market crash is coming, and this is how we know. As recently as the first quarter of 2022, the Federal Reserve maintained a near zero federal funds rate and continued its monthly purchases of billions of dollars in bonds to bolster the economy, even in the face of the United States experiencing its highest inflation levels in 40 years. However, when the Federal Reserve determined it was imperative to address the mounting inflation, it took decisive action. In the last 16 months, the central bank has elevated the federal funds rate by over 5 percentage points. This proactive measure has played a pivotal role in curbing the skyrocketing inflation rates that were eroding the buying power of ordinary Americans. Yet there's a darker side to all this that no one seems to be talking about. The U.S. government is owing $33 trillion, and each time interest rates increase by 1%, that's an extra $1 trillion on interest expenses. No one knows how we're going to make these payments, but still, they keep rising. The elevation of this interest rate, which signifies the rate at which commercial banks lend money out, serves the purpose of curbing the escalating inflation. Nevertheless, this increase carries significant implications for the federal government's borrowing expenses and, consequently, the nation's fiscal outlook. As the interest rates on U.S. Treasury securities climb, so do the federal government's borrowing costs. During the pandemic, the United States was able to secure cost-effective borrowing options due to historically low interest rates. However, as the Federal Reserve heightens the federal funds rate, short-term rates on Treasury securities will also rise, resulting in increased costs for certain federal borrowings. Anticipations surrounding short-term rates and inflation have already spurred an upswing in longer-term rates. As of June of this year, the Congressional Budget Office estimated that annual net interest expenditures would amount to $663 billion in 2023 and could nearly double over the next decade, surging from $745 billion in 2024 to $1.4 trillion in 2033, accumulating to $10.6 trillion over that period. However, should inflation surpass the CBO's projections and the Federal Reserve implement larger interest rate hikes than anticipated, these costs may escalate even more rapidly. This expansion in interest-related costs poses a substantial challenge in the long run. According to the CBO's projections, interest payments could accumulate to approximately $71 trillion over the next 30 years, comprising 35% of all federal revenues by 2053. In the coming decades, interest costs are poised to surpass other major government expenditures, outstripping defense spending in 2029, Medicare in 2046, and Social Security in 2051. The enduring fiscal issues confronting the United States are grave. While substantial borrowing was necessary to address the COVID-19 crisis, the pre-existing structural imbalance between spending and revenues remains sizable and is poised to expand rapidly. Moreover, as interest rates climb and the nation's debt swells, future borrowing will become even more costly. Over many years, leaders from both political parties have deferred difficult budgetary decisions and have failed to establish a sustainable fiscal trajectory. Those responsible for managing the finances of the United States have been reckless, and if action is not taken now and fast, doomsday is coming. This is not a government problem. It's an all-of-us problem, because if the top is hit, you know where it all crashes down to? The bottom. Over the past several years, the country's debt has exceeded the size of its gross domestic product, which stood at $26.13 trillion in the fourth quarter of 2022. The debt-to-GDP ratio serves as a valuable metric for assessing debt trends over extended periods, as it contextualizes the debt by measuring it against the scale of the national economy. In 1983, our debt, interest payments, internal revenue, and GDP were at the same level. However, now, less than 50 years later, our debt has risen to almost 9,000%, while internal revenue, GDP, and interest payments are still below 3,000%. In February 2023, the CBO projected that federal debt held by the public would rise from 98% of GDP in 2023 to 118% in 2033, an average increase of 2 percentage points per year. And that over that period, the growth of interest costs and mandatory spending would also outpace the growth of revenues in the economy, driving up debt. These factors, if persisting beyond 2033, would push federal debt higher still, to 195% of GDP in 2053. Yet, the government is still borrowing large sums of money. In February, there were talks on the government raising the statutory limit of $31 trillion on national debt, which it reached on January 19, 2023. President Joe Biden and the Republican-controlled House of Representatives seem to be on a collision course over raising the statutory limit on the national debt. House Republicans said they wanted Biden to accept significant, but unspecified spending cuts in exchange for raising the limit. However, the president insisted that raising the limit, which allowed the government to continue paying its obligations under the law on time, shouldn't be a budgetary bargaining chip. Raising the statutory debt limit has occurred 78 times since 1960, and it appears that this trend will not be ending anytime soon. The question on the lips of everyone now should be, how does this all end? If you're thinking a crash, your guess is as good as mine. When everyone anticipates a gentle economic transition, be prepared for a jolt. Recent economic history drives home this lesson. In October 2007, then San Francisco Fed President Janet Yellen remarked, "The most likely outcome is that the economy will move forward toward a soft landing, a mere 2 months before the onset of the Great Recession." Yellen's optimism wasn't isolated, as the pattern of soft landing predictions reaching their zenith just before turbulent economic downturns has been disconcertingly consistent. Perhaps this is why the majority of the population is still stuck in optimism, believing that the economy will keep sailing smoothly. Even economists have not been able to reach a uniform ground on determining if a recession is in view or not. However, it seems that the CEOs are convinced that a recession in the near future is inevitable. How? The majority of the S&P 500 surge originates from its top 7 components, underscoring a notably skewed landscape in the U.S. equity market. In 2023, the S&P 500 has witnessed a robust climb of approximately 12.5%, a remarkable recovery from its 2022 lows. However, recent analysis by stock market strategists has illuminated certain vulnerabilities associated with this upswing. This analysis highlights that the S&P 500's 2023 advance has been primarily propelled by its 7 most pivotal components, often referred to as the Magnificent Seven. These 7 entities represent the most extensive mega-cap technology stocks, including Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Collectively, these 7 stocks have surged by over 50% year-to-date, while the remaining 493 companies tracked by the index have registered a modest 5% increase. In other words, if we exclude the performance of these 7 tech giants, the index's current rally is reduced by more than half. The implication of this is very clear. If you take out the 7 companies or even just a few of them, the effects will be devastating. Understandably, people are comfortable because unemployment is at an all-time low, a record 50-year low. People have jobs, and they're managing to pay their bills. While there is some concern, it's not at a level where we need to worry about an impending market crash or recession. However, current data shows that there is indeed a lot to be worried about. The total U.S. consumer credit card debt has surpassed $1 trillion. Some might argue that $1 trillion credit card debt isn't that alarming because we've been using credit cards for a long time. Yet the interest rates on credit cards are currently at an all-time high due to rising rates, which can significantly impact people's ability to make payments. Now let's not forget about the 30 to 40 million students or Americans who had been granted relief from their student loan payments during the COVID-19 pandemic. This relief is coming to an end, which means that those 30 to 40 million people will have to start making monthly payments again. That's not all. Currently, mortgage rates have surged well beyond 7%, with some cases even reaching 8%. This marks an increase of about 4% to 5% compared to the record low mortgage rates we had just around a year and a half ago, which were hovering around 3%. As of now, mortgage rates are approximately 7% to 8%, reflecting a significant and sharp rise in interest rates. What's noteworthy is that despite this notable increase in interest rates, the weighted average rate has experienced only a marginal uptick. The impact has primarily affected those who are in the process of buying new homes, while those who have existing loans at lower rates have held on to them. The refinance business, which was once thriving, has now dwindled significantly. As a result, only prospective homebuyers are facing the brunt of these elevated mortgage rates. The overall number of homebuyers has decreased as people who own homes are reluctant to sell and switch from their 3% mortgage loans to the current 7% to 8% rates. It remains uncertain how long this situation will persist, as no one can predict with certainty. However, it's evident that many homeowners are committed to keeping their lower interest rate loans. So why are we still floating and why hasn't the crash come yet? Well, what we're seeing is the lag effect. Since 1981, economists have observed that after interest rates are increased and then subsequently halted, it takes approximately 11 months for a recession to manifest. So, if rates are raised again in November, there'll likely be a recession in October 2024, right before the elections. What amazing timing! Of course, I'm being sarcastic. But seeing as the majority of Americans are not anticipating the crash, I'm pretty sure there's going to be a nasty uproar. Fingers crossed.